Metrics Credit Partners is different to, I guess, the other presenters here today. We're a business that focuses on private market transactions. So all of the other presenters have spoken about listed equities and the like. Our business model is very much around providing our investors with access to alternative private debt markets. These are markets that are heavily dominated by the banks, and our skill set is really around the ability to access and provide our investors with exposure to that market. Myself and my partners established Metrics Credit Partners in June of 2013 when we launched our first fund. That fund started with one single investor and we had $75 million under management. Over the last 6 years, our business has now grown to having around 11 different funds, 2 ASX listed funds, almost 40 people in the business, a presence in Sydney and in Melbourne, and running assets under management now of over 4.6 billion. What we do is very much about direct origination of loan transactions with corporate borrowers. This is a market that requires deep, extensive relationships with banks, with corporate advisors, and with borrowers direct. The ability to originate quality transactions, giving our investors an exposure and the returns that can be generated from direct private lending. Obviously, credit risk analysis and the ability to negotiate terms and conditions to mitigate the risk of loss is a central feature of what we do. When we sit down with borrowers, we're looking to negotiate terms that mitigate the risk of loss. So we set appropriate terms, conditions, covenants, controls, required reporting, taking security, all designed to mitigate the risk of loss. Obviously, in the capital structure, people are investing in equities, looking for growth in capital. In our market, investors are looking to have stability of capital and generating a predictable, known income. Why do we exist? I guess the market that we exist in is really a heavily regulated, bank-dominated market. So back in 2008, through the GFC, it became our view that the banks would face into increasing regulatory pressure, increasing cost of funding pressure, and as a result of that, we didn't believe that the banks were the natural holders of the loan market assets that they currently hold on balance sheet. Because it's a regulated market, the market tends to be credit risk quality of an A to BB credit risk. Many investors have got exposure to US high yield markets or term loan B markets where the credit risk is at the other end of the spectrum. It tends to be BB to CCC credit risk. That market doesn't exist in the Australian market in the form of a loan. You can see there that the loss rates that have been achieved in direct lending are quite low. Largely to do with the fact that it's a regulated bank market, but also Australia operates we operate in one of the most favourable, creditor-friendly corporate insolvency legal frameworks that exist around the world. The ability to enforce our rights as a lender are important features in terms of our ability to mitigate risk of loss. But it's a market where most corporate borrowers are unrated, and so their access to capital outside of the bank market is quite difficult. So unlike, I guess, in other markets where you have a deep, liquid, functioning corporate bond market, in the Australian market, the corporate bond market is not significant. It doesn't provide any great opportunities for companies to raise capital in an efficient manner. Most borrowers that we deal with are looking to diversify their funding sources away from the banks. And so the ability for us to lend on terms and conditions and in a size and scale commensurate with the way in which a bank lends gives us the ability to bring our investors closer to the point of origination. By bringing our investors closer to the point of origination, we believe we're able to deliver better returns in the forms of higher fees without being intermediated by the banks. It's a market that is large and scalable. If I think about the corporate bond market, if you strip out financials and you strip out government and semi-government securities, it's around about 40-odd billion in outstandings. So at 4.6 billion, you can see that we're a material provider of debt and credit to the Australian corporate market. The banks, on the other hand, hold around about 1.2 billion or 1.2 trillion rather in assets on their balance sheet. It is our view that over time, those assets will need to go to alternative sources of capital. And given the immature nature of the Australian capital market, given the fact that most Australian borrowers are unrated, our skill set in terms of the ability to negotiate, the ability to analyse and assess credit risk and to determine the appropriate price and structure for that credit risk is something that we believe is valuable to our investor base. It is a private market. So as I said, these are not exchange traded. Very difficult for an investor to gain access to what we do. A transaction might take us between minimum 1 month to well in excess of a year. By the time we've originated it, structured the transaction, negotiated the terms and conditions with the borrower, completed all the legal documentation associated with settling the transaction, the securities and the like, they're long lead times. And so the ability to bring our skill set and deliver that in a way that investors can gain access to it, I think is unique in the market. It's an asset class that's exhibited very low volatility. I think one of the good things about now having 2 ASX listed funds is that that's now clearly known in the market. It's seen. Our performance is now publicly disclosed and investors can clearly see the performance of both MXT and MOT and the way they're performing on the market, the stability of capital that we've delivered and the way in which we've generated the returns. MXT provides investors with predictable, known monthly income. The target return for that particular fund is the RBA cash rate plus 3.25% net of fees and costs with distributions paid to investors monthly. And one of the attractions that we see in that market is the fact that investors do have downside protection that are afforded to us by appropriate terms, conditions, covenants. So covenants that control the outright level of leverage or the debt service capacity of the company are important features in terms of the way in which you control the operations of a company. Often, as a lender, the ability to restrict distributions to equity investors, so restricting dividends, restricting dividend flows is an important feature in terms of ensuring that we as a lender have priority access to cash flows. These are all important risk mitigation strategies that are adopted to minimise downside risk of loss to investors. Here are a couple of examples of companies that we lend to. We're active in really 4 or 5 key markets. We're an active corporate lender. So Mark mentioned a number of the ASX listed companies that we lend to, the likes of Woolworths, Caltex, Origin Energy, Brickworks and others. We're active in project and infrastructure funding, so the Eastern Distributor Motorway. We finance the Victorian Cancer Centre, the Grafton Prison. We're active in property markets, both for development funding and also for REITs. So development funding, that includes land subdivisions, it includes residential high-rise, we do industrial, commercial, mixed-use sites. We also provide funding to REIT groups like Charter Hall and others. And we're active in acquisition finance. Acquisition finance is predominantly event-driven financing provided to private equity firms buying other companies. Here's a list of the companies that we've lent to or have in our current portfolio. Every one of these logos are companies we have actually lent to or we have currently in our portfolio. I think the important thing about this is it's across industries, it's across credit quality, and it's across the capital structure. I think importantly though, it's also one of the things that isn't shown there are the companies that we don't lend to. I think for us as a firm, we looked at over 300 individual transactions in the last 12 months, of which we completed about 20% of those transactions. So it's important that we maintain discipline in terms of the credit quality and the assets that we lend to and the companies we lend to, and then it's important to ensure that we're monitoring the risk associated with those companies. How do investors access our funds? There's a range of both listed and unlisted funds. MXT to the left there is the ASX listed fund we launched in October of 2017. That fund has now grown to around about 1.3 billion in size as we've completed 3 capital raisings over the last 18 months. That fund is designed to be a large, liquid, low-cost structure to investors, providing investors with a means to access traditional fixed income in an ASX-listed format. Target return of the RBA cash rate plus 3.25% net of costs. Our view, though, is not all credit assets are homogenous. When we sit down and negotiate terms and conditions with a borrower, often we might require a company to contribute additional equity. We might be doing certain things to structure or mitigate the risk associated with the underlying performance of the company. And so it's our view that you can structure credit risk to provide a different risk-return objective to investors. So when we've structured our funds, we've sought to create different vehicles that really allow an investor to choose what is their risk objective, what is their return objective. And then have we created a vehicle that allows our investors the choice around liquidity options. So MOT was the second ASX listed fund we launched in April of 2019. We raised 300 million in that fund, and that fund was designed to provide investors with an alternative to equity market risk, providing them with a return profile commensurate with the returns you could achieve in the equity market, but lowering portfolio risk by moving into the debt part of the capital structure. We seek to provide investors in that fund with a target return of 7% per annum with income paid quarterly, and with the rights to participate in upside gains through options, warrants, or outright minority equity interests. And this is the historical performance of our funds. And so you can see the ability to differentiate risk and return for our investors. Investors can choose which return, which risk target they're looking to achieve. And then from our perspective, we've created a range of choice where investors can access. From our perspective, it's the means to pool capital and allow us to be relevant in the market to lend. You can see on the other part of the chart, the example I use there in relation to MXT, which is the low volatility and the returns are commensurate with alternative asset classes. It's just been a brief introduction to metrics, so thank you very much for your time.